Andrew Carnegie's net worth today would be about $309 billion. He knew how to make money. More importantly, he knew how to make money work for him. And what is the best way to do that? He said 90% of millionaires become so through owning real estate. And over 100 years later, that hasn't changed. Real estate is a multi-trillion-dollar industry that keeps growing. So how do you get your piece of the pie? In this video, I'm going to break down the 3 key concepts that you need to know to make money investing in real estate. If you want to buy a stock, you generally need 100% of the value of that stock in cash in order to buy it. If you want to buy a business, some banks may loan you some money, but generally up to 50%. You need to come up with half the amount of the business to buy it. Real estate's different. Banks understand how stable real estate is, and because of that, they're willing to loan more based on the value of the asset. So you could buy a $10 million piece of real estate, let's call it a $10 million apartment building, with $3 million tied up in the deal. This concept is called leverage, and what leverage allows you to do is tie up less money in a deal, but still reap all the rewards and the appreciation of that greater asset value. So let's say you tie up $3 million in that $10 million apartment building, and over time, the piece of real estate appreciates to $13 million. You've basically doubled your money with that $3 million increase because you only have $3 million tied up in the deal. This is how real estate investors become so wealthy, because they are making sure their money is working as hard as it possibly can in these deals because they're using leverage to its maximum potential. There's a common misconception when it comes to investing in real estate. Most people think that they're investing in the real estate, but that's not true. You're actually investing in a business that just happens to be tied to real estate. Your tenants are your customers. The housing, if it's an apartment building, is the product. And what's one thing businesses do really well? They earn a profit. And in real estate, profits come from a number of different sources. Number one, you have the rents, right? Your tenants with apartment buildings, they're paying you monthly rent to live there. You have other income streams like parking. Maybe you have premium parking, that's additional revenue stream. Maybe you have laundry. Laundry is another additional revenue stream. You have trash pickup. You have all these different profit centers within that piece of real estate. And this is how you drive more revenue into your pockets and the pockets of your investors. So how do you actually calculate how much revenue your property is producing? Let me break this down in this mathematical formula. First of all, we have to figure out what's called your gross income. With gross income, you add up all your different revenue streams. So this is going to include your rents, plus all your other revenue. Then we have to figure out your operating expenses. The expenses, the money that you have to pay out in order to operate your piece of real estate. And this can include your taxes, this can include payroll, this can include management, this can include utilities, all that kind of stuff. You add it up all together. And what we do to figure out your net operating income, the cash flow left over with your asset, we take your gross income and we subtract your operating expenses, and that gives us what's called your NOI, your net operating income. So we know our net operating income, but this doesn't tell us exactly how much money is coming into our pocket at the end of the day. To do this, we have to go below the line. Let me show you what I mean. We have our gross income up here, and we subtract our operating expenses, all the expenses, the money we have to pay out to manage the property. And this gives us our NOI. Now we draw a line, and we have to go below the line because we have leverage that we talked about with the first point. We are leveraging the bank's money in order to acquire these real estate assets and make sure our money is working as hard as possible. But there's a cost to that. We have to pay the bank interest. So what we do below the line now is we have to deduct or subtract our debt service costs, how much money we have to pay out every single month to service that debt, to pay those mortgages, to pay those loans. So now we subtract the debt service cost from our NOI, and this gives us our cash flow, or how much money is going into your pocket and your investors' pockets every single month. So you've leveraged your money, you have cash flow coming in, you have positive cash flow, money coming into your pockets every single month. Now, how do we make the really big bucks? Because cash flow, I call cash flow the cookie crumbs, but this third thing is going to be the cake, the big meal, the treat at the end. And we do this through what's called forced appreciation. This is where we take an underperforming asset, an asset that's operating below the market standard, and we use what's called two value levers to increase the value of the asset. This doesn't rely on waiting for the market to go up. This doesn't rely on inflation to take its course. This is something we can do today to force the value of that asset so we control how much the asset's worth. So the two value levers we're operating in this case, we have two of them. One is physical improvements, and then the other one is operational efficiencies. And both work together to force the value to increase the value of the asset in a way that we can control. Some examples of physical improvements in an apartment building could be redoing the kitchens, adding landscaping, repaving the parking lot, adding a new roof to it, adding amenities, adding a gym. All these types of things are physical things we're doing to the asset to make it more desirable for the tenants, so then they in turn pay more rent, and this increases our NOI, which then improves the value of the asset. On the operations side, the sky is the limit. Maybe we can reduce our tax bill. We can raise the rents, which is the best thing and easiest thing you can do. Maybe we can change the staffing so we're converting more potential renters into signed contracts. Maybe we're installing energy-saving light fixtures. Maybe we're installing water-saving toilets and faucets. You could revamp the advertising campaign, target a different demographic, change the messaging, change the signage on the building. There's so many different things you can do on both the physical side and the operation side to drive the value of the asset and improve it. The reason is commercial assets like apartment buildings are valued by the income, the net operating income produced. So the more you can drive the gross income that we talked about, the more money that's being produced by the asset, and the more you can optimize the expenses, so reduce those expenses that are going out every single month, the stronger your NOI, the greater the NOI, and the higher the value of your asset. At this point, you understand leverage, how to make your money work as hard as possible in the deal. You understand cash flow, and you know how to calculate how much money is coming into your pocket every single month. And you understand forced appreciation, how you can actually control the value of the asset by using two value levers, physical and operational improvements. But how do you actually structure these deals and organize them and put them together? There's actually 4 different ways you can do this. And in this video right here, I break down the 4 different ways you can buy an asset like an apartment building. So make sure you check out that video if you're interested in building wealth through real estate.